When people hear the word risk, their reaction is usually emotional. Risk feels negative. It feels dangerous. It feels like something to avoid. Many people associate risk with loss, mistakes, or regret. They imagine scenarios where things go wrong and assume that risk is the cause. Because of this, investing is often framed as a question of courage. Some people are brave enough to invest. Others are too afraid, but this framing is misleading. Risk is not a personality trait. It is not something only certain people face. And it is not limited to investing. Risk exists in every financial decision, including decisions that feel safe. This video is about redefining risk. Not as danger, but as uncertainty. Not as something to eliminate, but as something to understand. Once risk is understood, fear loses much of its power. Many beginners believe that avoiding the stock market means avoiding risk. Keeping money in cash feels stable. The number does not move. There are no headlines. No sudden drops. But stability in the short term does not mean safety in the long term. Over time, money loses purchasing power. Prices slowly increase. The cost of goods and services rises. What money can buy today may cost more in the future. This process is gradual. It does not feel dramatic. That is why it is often ignored. But ignoring a risk does not remove it. Choosing not to invest is still a decision, and like all decisions, it has consequences over time. Understanding this changes how risk is perceived. In investing, risk does not mean that something bad will happen. It means that outcomes are uncertain. There is no guarantee that returns will be positive. There is no guarantee that timing will be perfect. There is no guarantee that expectations will be met. Uncertainty exists because the future cannot be predicted with precision. This uncertainty is not a weakness of the system. It is the reason the system exists. If outcomes were certain, returns would be minimal. People are compensated for accepting uncertainty and waiting over time. Risk, therefore, is not a flaw. It is a feature. Returns do not come from intelligence or luck alone. They exist because investors accept uncertainty, delay consumption, and allow time to pass. Money invested is money not used immediately. This delay creates opportunity for growth. Businesses use capital to build products, improve efficiency, expand operations, and innovate. Returns reflect participation in this process. They are not rewards for clever decisions. They are compensation for time and uncertainty. One of the most important ideas in investing is the relationship between risk and expected return. In general, investments with lower uncertainty tend to offer lower expected returns. Investments with higher uncertainty tend to offer higher potential returns. This does not mean that higher risk guarantees higher returns. It means that over long periods, people expect to be compensated for uncertainty. This expectation influences how assets are priced. Ignoring this relationship leads to unrealistic expectations. Many beginners look for certainty. They want guarantees, fixed outcomes, clear promises. But in investing, guarantees are rare, and when they appear, they often come with trade-offs. Guaranteed outcomes usually mean lower potential returns, limited flexibility, or hidden risks elsewhere. Understanding that uncertainty is unavoidable helps avoid false confidence. In the short term, risk feels dramatic. Prices move quickly. News headlines amplify emotion. Fear and optimism spread fast. Short-term volatility attracts attention because it is visible. But visibility does not equal importance. Short-term fluctuations often reflect emotion more than fundamentals. Reacting to them increases mistakes. In the long term, risk becomes quieter. Businesses adapt. Economies evolve. Productivity changes gradually. Long-term outcomes depend more on structure than on timing. This is why long-term investors focus on fundamentals rather than daily movements. Time changes the nature of risk. Volatility simply describes how much prices move. It does not predict failure. It does not signal danger by itself. Volatility becomes harmful only when it triggers emotional reactions. Understanding volatility helps separate discomfort from actual risk. Diversification spreads uncertainty. Instead of relying on one outcome, it allows many outcomes to coexist. Some investments will perform well. Others will not. Diversification does not remove risk, but it prevents any single outcome from dominating the result. This is why diversification is a core principle of long-term investing. Expectations determine how outcomes feel. If someone expects constant growth, normal volatility feels like failure. If someone expects variability, volatility feels manageable. Most disappointment comes from mismatched expectations, not poor structure. Understanding this reduces emotional stress. Many investing mistakes are behavioral. Fear leads to selling at bad times. Optimism leads to chasing performance. These behaviors increase risk rather than reduce it. Systems that reduce decision-making help control behavior. Short-term returns do not measure intelligence. They often reflect timing or randomness. Long-term returns reflect participation and patience. Understanding this prevents overconfidence and discouragement. Beginners should expect uncertainty, variability, learn over time. They should not expect constant success, smooth results, or perfect clarity. Understanding develops gradually. Complex strategies create more opportunities for mistakes. Simple systems are easier to maintain. Simplicity supports consistency. Consistency supports long-term outcomes. Time amplifies structure. Good decisions benefit from time. Poor decisions also benefit from time. Time rewards patience more than precision. Risk cannot be removed. Returns cannot be guaranteed. But expectations can be aligned with reality. Understanding risk, returns, and expectations transforms investing into a structured process instead of an emotional one. Fear fades when uncertainty is understood. Urgency fades when time is respected. This understanding is the foundation of long-term thinking.